Good morning, everybody. Welcome to Friday. Looking forward, as always, to our session. I'm just setting up my sharing options right now. There we go. Excited for our discussion today. As always, there's plenty to talk about. Really quickly, before we start to get into the analysis, uh, I do want to talk really quickly about those of you that are on Discord. I mentioned last week that I'm going to transition everybody to work off of Substack. That doesn't mean Discord is going away right away. I'm going to continue to publish content and continue to maintain my Discord server as I have for the time being. But I do eventually want to be able to primarily work with and interact with you through Substack and through this webinar, through this live stream. Excuse me. That means that in order to facilitate that, my plan last weekend was to do kind of a mass migration of everybody from Discord to Substack. But when I exported my member list, my server member list from Discord, it gave me all kinds of data, but not email addresses, and so I wasn't able to send out those notifications. For that reason, I posted a message last Saturday in the open discussion channel asking you to message me with your email address so that I could set up your access in Substack. So I really just very quickly want to show you how to do that. The simplest way, and I can't do it exactly from one of these channels because, well, this is me. But let me see. Actually, I can show you right here. So Jay, I apologize. I'm going to be using you as my guinea pig for this example. But if I wanted to message Carthoris here, I can click on the avatar of his user, and it'll give me this pop-up where I can go ahead and send him a direct message. You can just put in your email address in this in this message field, and go ahead and send that over to me. That's all it takes. Very simple, and then I will be able to set up your access in Substack and send you an email with an invitation to join that community. Once you have that, then you will have exactly the same access on Substack that you have on Discord. You'll have access to everything that your membership has entitled you to. If you're a member of the ITG group, that means that everything that you have had for the last several years will continue to be in place, and that's not going to change. Whatever you have, whatever you may have paid for, if you are not a member of the ITG group, those rights will also filter over. I've set up the same membership levels on Substack that I'm using on Discord. Okay. If you have any questions about that, any concerns, don't hesitate to reach out to me. You can message me again in Discord if you want. You can send me an email, whatever your preference is. Hello, Jay. Thank you. Hope you don't mind that I used you as my example. Okay. Been on vacation. Okay. Well, you don't be sorry about that. That is not a problem. Vacation is a good thing. All right. Let's go ahead and dive straight in. Market is again, as always, there's lots to talk about. Looks like as we're in the very early minutes of the market, it looks like we're trying to push a little bit higher to finish out the week and follow through on this rally that looks like we may be in the neighborhood of a breakout here. The market has been pushing the last 3 days right up against resistance from this pivot high in early May, and looks like we're breaking above it, and that could set up an opportunity for the market to rally all the way up here to about 6,100. So there's about 100 points of room here in the broad market, at least in the near term. We'll see what happens if and when we get to this 6,100 point level for the S&P 500. I do expect that to provide pretty strong resistance, and there is still a lot going on in the broad macro view that is likely to keep things on maybe uneven footing, even while the market is trying to find reasons to stay bullish. That's still one of the reasons, even as the rally has been in place, that the theme that I've been using for the trades that I've been placing, as well as if you've been following my daily posts, I've really been trying to tighten up the kinds of stocks that I'm paying attention to. I've started using terms like equity bonds more because I'm trying to focus on stocks that have not just really great fundamentals and good value propositions. Those have been a hallmark of Rebel Income from the beginning. Dividends have also been one of the key indicators and key factors of the kinds of stocks that I filter out, since I only work with dividend paying stocks. But I've increased my focus and my scrutiny on dividend quality, and I'm starting to differentiate more between stocks that simply pay a dividend versus those that have a high quality dividend. And that's tightening my analysis a little bit. And actually, I kind of feel more comfortable with it this way. If you think about the market's rally since April, and you try to put this in the context of risk and reward, and I'm not going to talk about macroeconomic environment or some of those kinds of questions right now. I just want to talk from a strictly technical standpoint. We want to talk about risk reward based on the charts. If this breakout continues to follow through all the way to this peak, remember, the market has a very well documented history of hitting emotional levels. And when I say emotional levels, previous all-time highs are really good indications of emotional levels that the market does not always categorically push above. Sometimes it does. Here's a really good example here. After a temporary pause in July, August of last year at around 59, we got a breakout, right? And this thing continued, and it kept breaking out until we got to this peak at around 6,100. So all of these were extensions of an upward trend that was already in place. So that could happen here. Again, we could see this break above 6,100. However, the fact that we saw such a significant drop off of this level beginning in February, and again, the dynamics that influence this, but the fact that this offered such strong resistance all the way back in February implies that as the market gets back closer to this level, don't be surprised to see some more consolidation, something maybe along these lines. I'm not saying that it's going to go bearish or that it's not going to be bullish. I am saying that this is going to be an emotional level that the market is going to have to reckon with before it figures out what is next. Now, if we see a really strong push above it, then this is probably, then we're going to be looking at another extension of this. Sorry, my lines are getting all mixed up. Of this longer upward trend, then that will extend itself even further. But for now, what I'm calling for and what I'm saying is that with 100 points of upside against probably, if I'm trying to find downside here, if I'm trying to think about where, if it does break down, if it doesn't break above this, but actually moves to the downside, where is it going to be likely to find support? Well, if I want to be kind of a gloom and doom type, I could probably go at about 5,800, where the 50-day moving average is. I could use that as support if I want to try to be a little bit more cautious. With the 20-day moving average, the slope here makes this one a little bit harder for me to totally buy into, but possibly 5,900, where we're seeing the 20-day moving average right now, could also be that. So this would mean about 100 points of upside versus about 100 points of downside. So 1-to-1 reward to risk. If it's more like here, then this is 200 points of downside. I'm going to put minus signs here versus my 100 points of upside right now. So reward to risk is either 1-to-1 or 2-to-1, or excuse me, 1-to-2 right now. That's a little bit backwards from what I would be looking for in a normal bullish case. I'd be looking, just like I would with any kind of very near term momentum based trade. I'd be looking for reward to risk of at least 2-to-1 in order to really be comfortable with placing that trade. And so from the market, I think it's reasonable to expect the same thing. If I want to be categorically bullish, if I want to be all in on what the market's overall trend is right now, I'd want to see at least 2-to-1 reward to risk. And that's clearly not in place right now. That doesn't exist. Again, this does not mean that I'm bearish. It means that I'm cautious. It means that I expect to see continued volatility and swings in both directions. And so the tone of the trades that I've been placing and the things that I've been writing about, I'm not actually planning on conservative and intentional. Trying to be very intentional about the trades that I place, I think, is something that I need that is important and going to be useful for all of us. Okay. What does that mean for you? Should you continue to place the trades that I'm placing? That's an individual decision. Certainly, I hope that when you see me send out a trade alert, you're evaluating it on your own to make your own determination as to its suitability, rather than just saying, "Okay, here's Thomas's trade. I'm in. I'm going." You're making your own comparison and making your own evaluation. I will say, if I don't feel like conditions are right for a trade in any given week, I still reserve the right to hold off. So if I do send out a trade alert, that means that I feel like that's a good opportunity based on current conditions. At any given point, you are free to agree or disagree, and to follow your own logic and your own instinct. Your own judgment is a good thing. Okay. All right. Any other thoughts about current market conditions? About any questions about what's happening in a broad sense? Any opinions about what's happening in a broad sense, for that matter? Go ahead and put them in the chat. All right. We do have a one trade that is on deck for expiration today, and that is a put sell on Schlumberger. Jay, volatility still scares you, and reasonable. How do you respond to that fear? That's really the question, right? Volatility is something that on the one side, it inflates premiums, and so as an option seller, that's attractive. But I appreciate, Barry, can we just get some consistency? Wouldn't that be nice? And I hope you mean from the market, because I am trying to be consistent in what I am doing. Gib volatility is low for you. Okay, that's fine. That's fine. The question is what you do. What you do with the feeling that you have in the market. If volatility scares you, there's a couple of different things you can do. Right. The maybe the traditional school of thought is if you're afraid of it, go to the sidelines and wait. There's some logic to that, and I'm not entirely opposed to it. Simply because the truth is there's always another opportunity down the road. The market is, we know the market is resilient enough that if you don't like the way things are right now, you can go ahead and wait. Thank you, Barry. Just making sure. um, it's resilient enough that the market will always be ready for you when you are ready to come back to it, right? And so if there's ever a situation where it just doesn't make sense to you right now, that's always something that is worth considering. So I'll never totally discount the idea of moving to the sidelines. At the same time, I think that even in periods of of increased volatility, and there are plenty of stocks right now that are still seeing very high volatility. In those kinds of periods, I think that it's still useful to think about ways to keep your money working for you. And that's why that's kind of why I'm tightening my focus to lean really heavily into this equity bond thing. It doesn't mean that those stocks can't be volatile, but it does mean that the core businesses are strong enough, especially related to free cash flow, related to liquidity versus long-term debt leverage, those kinds of things. There's always Barry's favorite trade, right, to consider if you want to play with volatility. There's NVDL. Thank you, Barry. I appreciate that. Um, Equity bond type stocks can still drop in price, but they have a much more balanced reason built in for recovery. And I'm trying to not only identify those that have that equity bond characteristic, but also have an attractive value proposition go as well. So they're already trading at deep discounts. Again, that doesn't mean they can't continue to drop potentially if they're in a downward trend, but it does hopefully start to shift the probabilities more in our favor as we're placing these trades. And so um, that does mean that even if I'm a little bit worried about volatility, I'm still going to try to take advantage of those opportunities to place those trades and keep my money working for me. I'm just going to be more conservative about the amount of money that I allocate. Position sizing, boom, there's that drum again, is going to be something that I need to really pay a lot of attention in this current environment. Yeah. And Barry, another good week for NVDL. There you go. Not surprised. And really quickly, because he brought it up, we'll get into some of our weekly trades here in a sec. But Barry is talking about NVDL, and here we go. Another nice rally this week, so good, some good momentum there for you. Again, lots of ways to work with the market that can all work for you right now. That don't necessarily have to lean on just one method or one approach. Okay. As I mentioned, I have one trade that is on deck for expiry, so let's start with that one. That's Schlumberger. And we can see the stock right now sitting in a consolidation range. Pretty tight one over the last few weeks. Top end is right around my 20-day moving average, which is right at about $34, with support down, maybe I'll call this 32.50 roughly. Jay says, I'm not sharing a screen. Can anybody, is anybody else not able to see my chart? Gib, you can't see it. Okay. Give me just a second. Let me try again. Okay. How about now? Perfect. Thank you, Jay. I really appreciate that feedback. Wonderful. Okay. So we've got a pretty narrow consolidation. Barry is not seeing it. Okay. Let me try one more time. Oh, you do. Okay. All right. So here's our consolidation range. Thank you. Everybody that's in so far is seeing it. So again, if we experience any interruptions, don't hesitate to tell me. This consolidation range is pretty tight right now for Schlumberger. I like that. I don't. These periods of consolidation work really, really well for the kinds of income generating trades I like to place. So let's take a look real quick at the setup. This is a trade that I placed about 2 weeks ago, selling the $34 strike price, bringing in a little over 2.5% for that time period. And so it's just a little bit below that price right now. 33.90 is where it's pushing right now. So it's very, very close to 34. If I hold this through the close of the market, will I get assigned? Maybe. If it's even a penny below 34, I will. Right now it looks like I will. I don't know. The high for the day is 34.06. So if it gets back up to that level or even pushes a little bit higher above that, then this option will expire. This is interesting though, because it does offer and open up the opportunity to evaluate whether or not to close the trade early, which is always interesting. Now, for reference, again, I brought in 88 cents on this trade, and I could buy it back right now for 26. That's interesting. Look at the way the bid and ask difference just increased. Let's see what this looks like in terms of details. Not a ton of volume, but there has been a bit. Plenty of open interest. Now, if I didn't want to have to worry about whether or not I was going to be assigned, I could enter a buy to close order. That can't be practical. I'm not going to go along with that. Let's just ignore that for now. That's got to be that's strange to have the ask price suddenly shift so high. If I were to try to put in, say, a buy to close order right now at around 25 cents, given the level of volume, it looks like that would probably be taken right away. If I wanted to try to play out the fact that this is going to expire today and be even more try to force the market to come to me. I could put it in for, I don't know, 15 cents, 10 cents, 5 cents, whatever, and just try to wait out the market. If the momentum for the stock continues to play out, then at very, very near 34, then odds are one of those prices should work. If it gets it all above 34, the ask should shrink even more. So the fact that it is where it is right now at around 26 is really a reflection, I would say, more than anything else, of the probably the expectation that it's going to finish below this price. But we've still got a few hours to go. So you can play this a couple of different ways. If you did want to buy this back and free up that capital right away, that does make some sense. I'm not going to dismiss it. It is interesting if you wanted to buy that back, remove that obligation, but still continue to work with Schlumberger. Here's a little over 1% available at 33.50. If you don't mind the idea of rolling forward in time a little bit, you can actually go down from 34 to 33.50. Work with a little bit lower strike price and get a little over 1% for that. Plenty of open interest again, more than enough volume to carry out that trade. It's interesting. 33.50 here, you're well above 1.5%. Here's a little bit more conservative at 33 for 2 weeks. I'm not saying that you have to do any one of these, but if you are of a mindset of trying to increase trading frequency, and there is a real difference, right, between closing out an obligation on a trade today before the market closes so that you can use that capital right away versus my normal method, which is to wait out the market, let it settle. If I get assigned, I get assigned. If it expires, that's okay. I get my capital back, but I don't get my capital back. I can't use it again until Monday or Tuesday. Maybe that sounds like a minor difference, but that adds up in terms of the number of trades you can place over the course of a year. With the same kind of trading frequency that we're talking about, similar kind of returns we're usually seeing around 1 to 1.5%. You add those up, that becomes a material difference. So it depends on what you want to do. I like Schlumberger. I don't mind if I am assigned, and it's come even closer to 34 just in the amount of time I've been talking. I don't mind if I am assigned at 34 with the stock in this consolidation range. That really just means that if I am, there's a really, really good chance right now that I'll have an interesting covered call trade to think about on Monday or Tuesday. And so you'll probably see me write about that in next week's trading highlight. That's nice, especially since the ex-dividend date for this stock was on Wednesday. So even if I'm assigned, I'm not going to get this dividend. Being able to sell a covered call next week potentially is another way to give myself an easy dividend, and probably very possibly more than what this quarterly dividend is going to be. So, do you want to take assignment on it? Do you want to avoid it? Totally a question of what your preference is. So the thing, there's not a right or wrong answer to the question. I like to take this. I like to let these sort out. I like to wait through expiration, and the result is the result. This is one of the reasons why I like to refer to put selling as a gateway to stock ownership. These are stocks I like. These are stocks I don't mind owning anyway. And so if that's the case, why not take the assignment and try to leverage the opportunity to sell a covered call. It's also just easier for the context of the way that I need to be able to manage my investing system, my personal investing system. Makes it easier to manage Rebel Income as a service for you, and also just to try to keep things in a reasonable context within the requirements of my life. Remember, investing is a part of our life. It's not the dominating feature, right? It's just one more thing we do along with everything else. Says the guy that does this for a living. All right. Any other thoughts on Schlumberger? Anybody else that's working with this trade has some different numbers they want to compare, or a different idea about it? We're swinging back to NVDL. No problem. Barry, there's going to be one requirement I'm going to ask of you, since I know that you have. I felt you sent me your information to migrate over to Substack. While I'm reviewing your NVDL details, which are awesome, by the way, if you wouldn't mind sharing what you think so far of Substack in the little bit of time since I set up your account, if you've been able to get over to the site and look at it and compare it to what you're used to, or perhaps become used to with Discord, I'd be really interested in that perspective, and hopefully that'll be something that'll help everybody else too. So he's in NVDL at $50. He brought in 1.5% exactly on a one-day trade on May 23rd. I remember we talked about that last week. Then last week wrote a $55 call for 209, and on Monday wrote a $56 call for $1.20 expiring today. Looks like you're going to get called out. This is awesome. Like I said, these are really, really great results. So just let me switch to my typing tool. There we go. Barry, thank you. NVDL. I'll say NVDL trades. One put sale. $523 assigned at $50 and 75 cents premium, 1.5%. That was trade one. Trade two, covered call. $55 strike. Expired on 5/30. $1.20 premium. Let me just go over here really quickly. $1.20 divided by 50. There's 2.4%. And trade three, So all of these are within the last 2 weeks, right? For for context, here's a new cover call, 56. Oops, $56 strike price. Oh, sorry, 209. You're right. Thank you. I got ahead of myself. Appreciate the correction. 209, 4.18. There's an example of taking advantage of volatility, right? 4.18%, $56 strike. And looks like you're going to be called out. It's at pushing up towards, not quite to 58 yet, but it's on its way there, it looks like. And this one, $1.20 premium, which we know is 2.4%, plus, so you're assigned at 50, right? 56, so you get a $6 capital gain. Which is 12%. I should probably have been able to do that math in my head, but that's okay. It's better when I don't try. 12%. So this is just the net result so far. I'm sure at this rate, Barry's going to probably turn around and look for another opportunity. Let's see, all premiums, 75 cents, $1.20. Let's just do the math again. Let's do this the right way, shall we? 75 plus 209 plus $1.20, 404. $10.04. Yeah, sure enough, he's going to wait for the price to drop a little bit and then look for a new opportunity. But in the meantime, 10.04 divided by 50. We're already just a little over 20%. There we go. %, 0.08%. Total duration, about 14 days. Maybe a little over that. 14 or 15 days, roughly. It's 2 weeks of time, folks. And I'm not saying I'm not saying that this is going to be repeatable in every single case, but the interesting thing here that I appreciate about this, you won't see me highlighting any trades on NVDL. This is an ETF. It doesn't pay dividends. It's an ETF tied to NVIDIA's stock price movement. It offers an opportunity to work with and to take advantage of if NVIDIA moves at a lower stock price than the stock itself. But what this has done is this has given a way for Barry to look at what the stock is doing, take advantage of this trend that we have that has developed since April, and really take advantage of it in a practical way. It's easy to say, well, if you bought down here at 28 and now he's at 58, that's, a $30 difference. That would be even better. Double his money then in that case. Sure, that's true. But look at what he was able to do if he bought the when he was assigned the stock at 50. If all he did was hold the stock during that period, he'd be looking at about an $8 gain. But by employing some active, but by employing some the ability to recognize some opportunities with covered calls, just picking the low hanging fruit of the market, just taking the money that is waiting for somebody to claim, he was able to increase that result by an additional $2. That's a 25% difference over just a simple buy and hold. If that doesn't land, if that doesn't resonate, I don't know what else to say. So this is why I'm such a fan of being the option seller. This is a really good example of that, just because of the opportunity to take advantage of momentum. So, all right, Barry, thank you. I really appreciate that. And yeah, you're right. This is one way to work with volatility, I guess, if you want to try to do that. The caveat is to pay really, really close attention, to where these levels are. Pay attention to pivots. Look for breakdowns. Be ready and willing to move quickly to limit loss and manage your position accordingly. These are not set it and forget it kinds of trades. At least not if you're going to do something like what Barry has been doing with NVDL. Okay. Thank you, Barry. Again, I appreciate your being willing to share your results with everybody. That definitely helps. Okay, let's take a look at some of the others we have on deck. Couple of put sales from the last couple of weeks. These are still a couple of weeks from expiration, which means that there's good opportunity here to evaluate where they stand relative to those strike prices right now, and to look at current momentum and see if that's how that is influencing the position right now. Does that trigger a similar kind of evaluation to what we went through with Schlumberger before? So let's start here with SWK. This is Stanley Black & Decker. My father was not an active investor, but if he had been, this is a company that he would have been a big fan of, believe me. Sorry, and I thank you, Barry. Still getting, when he said talking about Substack, still getting used to it. It's now emailing your trade ideas and such like in the old days, right? That sends out an automatic email notification every time I add a new post. So you just received an email regarding the USB report. I post those every single day. The trade alerts are still every Tuesday. There's also an article on Thursdays, plus the alert that I'll send out with this link to this live stream. So and then anytime I post something on YouTube, I'll also post it in Substack first and give you early access before I make it available publicly. So thank you, Barry. So again, if you haven't, just one more plug. If you haven't, please send me that email address so I can get you set up on Substack. I do think you're going to like it better. Okay. Stanley Black & Decker. This is a stock company that's been around for a very long time. As I mentioned, my father was kind of a self-taught handyman, journeyman, if you will. And he loved working with tools. He loved home improvement projects, and he loved trying to get me to go along with him and help him. That's been useful now as an adult and with my own kids, but I'm not the handyman he was. but I still have an appreciation of good tools. Anyway, that's why this was kind of an interesting trade when it came across my desk. Certainly happy to have the stock in my watch list. This is a nice trade. The stock selling the 62.50 strike price and generating just a little under 2% for a 2-week trade. So this has only been in place for about 10 days. I've still got about 2 weeks to expiration on this, but let's take a look at where we're at. Stock's at 66.31. Selling the 62.50 means I'm in pretty good position right now. And in fact, even though it's only been 10 days, there's probably enough difference between these two. 62.50, my strike is down around here. This is the price that I said that I would be willing to buy Stanley Black & Decker for. It still is. I still like that level. But there's enough momentum there for me to think about, well, maybe is there an opportunity to maybe apply this more active rolling method. Now, this is one of those stocks that doesn't have weekly options. So rolling in this case isn't necessarily a matter of rolling further out in time. At least not for me, because I don't want to go out. Oops. How did I get the arrow? I don't want to go out 42 days. A month and a half isn't of interest to me. That's me. Again, bringing in $1.20 on this. If I wanted to buy this back, there's about a 15-cent difference between bid and ask at the 62.50 strike. Take a look at the details here. No volume here right now, but here's plenty of open interest. If I wanted to maybe split the difference here, maybe 60 cents, I think there's a fair chance that trade would be taken. That would mean that I would, here's $1.20, which is the premium that I brought in. This would be an opportunity right now, just based on the stock's momentum, to possibly claim 50% of the premium I brought in, a little under 1% for 10 days, and then think about possibly rolling up to a little bit higher strike price if I wanted to try to work with the stock's momentum. And here's another $120 total, $1.20 per share available at 65. And again, not a ton of volume, but plenty of open interest. There's enough here to make that work. So in the process, if I placed no other trades for the next 2 weeks in Stanley Black & Decker, that would allow me to increase my total premium to $1.80. Let's see, price, the difference between 62.50 and 65. Divided by 2. This is, well, actually, I'm not going to do that. I'm just going to take this off of 65, since that becomes my new assignment price. Excuse me. I'm trying to make that more complicated. This would take a 3-week trade and turn it into from 1.92%, which is what I've already secured so far, and It's an opportunity to increase my total premium and my total income return on this to 2.76% for exactly the same amount of time, because I'm still working with the June week 3 expiration. That's interesting. Again, not a recommendation to buy or sell. I'm not saying this is what you have to do. I'm saying this is an alternative. This is an interesting choice. This is a really good, another good example of the advantage of trading frequency. It does require a little bit more capital, right? To go from 62.50 to 65, you've got to reserve about $250 more per contract. If you're working with multiple contracts, that becomes a more significant thing. So you need to evaluate whether or not you have the room to do that. But all things being equal, this would be an example, maybe not as dramatic as NVDL, but it's applying a lot of the same kind of mindset and approach as what Barry has been doing with that stock. Any other thoughts? Any questions? Opinions? Agreements? Disagreements? Tell me what you think. Is this helpful? Does this make sense? I know for those of you that are here that you're the regulars, so we kind of share this narrative from one week to the next. But if you have something else that you think you would do differently on this one, let's talk about it. All right. The only other put sale is on Pfizer. This was this week's trade, selling the 2350 strike for a 2 weeks. It's also the same June 20th expiration, bringing in a little over 2% on this one. As I've tried to make sure is clear, every time I publish a new trade on Pfizer, for me, being into this stock at a much higher price, these are just repeated opportunities to, if I am assigned to lower my average cost basis and try to manage that position a little bit differently. But at 23.50, bringing in 50 cents, the stock is just a little bit above that level right now. I've only been in it for a few days, so that means it's not likely to have moved enough to make an opportunity to consider rolling or anything along those lines too practical. Let's just check into the numbers really quickly. This does offer weekly options. Here's the 23.50 strike price that I'm working with. The current asking price is 40 cents. I brought in 50, so only about a 10-cent difference between those two. Again, I'm not motivated to try to do anything on this one. I'm just going to let it play out for another week and see what happens. But we do have the stock kind of setting a new consolidation range here. Top end around 23.50, maybe a little bit above that. Low end right around 23. And that's after a short consolidation here. And then, of course, we have this lower low here. So this is interesting because if we connect our hot pattern of higher lows, we start to get a very interesting short-term upward trend. Not as dramatic as NVDL or maybe even Stanley Black & Decker, but still an upward trend here that is starting to work in Pfizer's favor. It does have some good momentum going on right now. Is that going to continue, or is it going to fade back again? You know, we are still looking at a pretty strong overall downward trend on the stock. If we were talking about trying to follow the pattern of declining peaks, right? 20-day moving average is all the way up here at 26, but literally speaking, resistance from the trend is actually right around the top end of this consolidation range. So that should probably keep that in place for the time being. Time being maybe could be 1 day, could be a week, could be a little bit longer. But that I would expect 2350 roughly. Call it 2375 if you want, to hold as pretty strong resistance for the time being. So we'll see what happens with the stock here as far as what between now and the 20th. If I get assigned here, I'm okay with that. That's just another opportunity for me to take on some additional shares in this stock, which I already liked anyway. I liked it at the higher $50 price where I was assigned. And so being assigned down here in this range just gives me an opportunity to manage that cost a little bit lower, push it down actually a little bit below 40, which I like. So, all right. The only other trade on deck that I'm waiting on and working with is FCX covered call. There we go. Now I'm working with the $41 strike. Barry's working with 42. He went with a little bit lower premium than I got. Now you wrote the call on 5/27, and for me it took another week. And you're in at 41 from March. I'm in at 40. So 41 gives me a $1 potential capital gain if I get called out. You've already done another covered call in the meantime, where I've been waiting. I had one other covered call here at 40.50 that expired, bringing in 77 cents. So we've got a similar thing going on, Barry, as far as FCX goes, but with some different numbers naturally because of the difference in the prices that we were assigned. So this was a really nice opportunity, almost 3% for a 9-day trade, with the stock showing some nice momentum. So let's see where this one sits right now at 42.20. Looks like we're both in a pretty good position right now. And I'm sorry, you have a $42 call, so you've got the same $1 capital gain baked into your covered call right now. So here's how I'm going to call this one. Here's me. Here's Barry. Mine's a little bit ugly, but they're about the same size. We both got to win here. These are good trades. Barry gets another tick, another bigger one, because of NVDL, and I'm going to squiggle that one a little bit. So this is another FCX. This is another good example of why I don't avoid assignments on these trades. I don't take advantage of the same kind of momentum. I'm not going to be placing the same number of trades that you're going to see from Barry or some of the others with stocks like NVDL, or from some of our rollers who are going to really be able to leverage upward trends like this by placing multiple trades in a very, very short period of time. But I am going to be able to take advantage of opportunities to sell covered calls, possibly to sell multiple put sales along the trend. It's just going to be a little bit lower number of trades. And I'm okay with that. I'm actively willing to accept that net lower result for still being able to be functional within the context of what I work with. That's the big question, isn't it? It's making your investing system work for you in the context that makes the most sense for you and is the most manageable. So, with that, I hope this has been useful, everybody. I really appreciate your participation as always. I hope you have a wonderful weekend. As always, if you have anything that comes up between now and next Friday, don't hesitate to let me know. Reach out, send me an email, reach out on Discord, reach out on Substack, whatever the preference is. I'll be looking for your messages and I'll try to respond just as soon as I can. Again, thanks everybody. Have a wonderful weekend. We'll talk next time.